Welcome to the Daily Update Podcast, where I'll go over the action in the market for Wednesday, October 1st, and we'll see how things look for Thursday, October 2nd. Going over Wednesday's market action, the major market indexes, the Dow, NASDAQ, NASDAQ 100, and S&P 500, surged to new all-time highs, signaling robust bullish momentum. However, mid-caps and small caps did lag behind, struggling to keep pace with their large-cap counterparts. The S&P 500 did open lower but found support at the S1 level at 66.56, climbed to the daily pivot at 66.74, and closed near its intraday high, up 0.34% on above average volume. Notably, the S&P broke through resistance at 6,700, a significant psychological and recent technical threshold, before closing just shy of its peak. Moving on to economic data, the economic reports released on Wednesday played a pivotal role. The ADP Employment Change report showed a surprising decline of 32,000 jobs, far below expectations of a 40,000 job gain, with the prior report being revised down from 54,000 in the plus side to minus 3,000. The MBA Mortgage Application Index dropped 12.7% week over week, compared to a modest 0.6% rise in the previous week. Meanwhile, ISM Manufacturing came in at 49.1, slightly below the anticipated 49.2, but up from 48.7. Readings below 50 indicate contraction in the manufacturing economy. On a brighter note, the Global Manufacturing Index held steady at 52, signaling expansion. These weaker-than-expected reports appeared to bolster market sentiment, likely reinforcing expectations of a Fed rate cut at the end of October. Speaking of sentiment, the S&P's reaction to the ongoing U.S. government shutdown has been muted, consistent with historical trends where shutdowns typically prompt short-lived negative responses. Investors seem to view any dips as buying opportunities, a dynamic that contributed to Wednesday's rally. Additionally, declining interest rates, with the 10-year yield falling to 4.11% from 4.15%, and a weaker U.S. dollar provided support for stocks. From a technical perspective, the S&P 500's performance was underpinned by positive signals across the short, intermediate, and long-term timeframes. The parabolic SAR, an intermediate-term indicator, flipped from negative to positive, which is a bullish development. Short-term indicators, including the Williams percent R, CCI charts, and stochastics, reflect growing positive short-term conviction, though the RSI based on 9 periods and the Chaikin oscillator are hinting at overextension. The S&P is now 11.4% above its 200-day simple moving average, raising concerns about sustainability, though no specific upward threshold show an imminent reversal. Volume continues to lead price action, a positive sign, but mixed signals from the advanced decline lines and growth-to-value ratios suggest some underlying caution. Moving over to sector performance. Healthcare was the strongest sector, gaining over 3%, driven by positive developments around prescription drug exchanges. Tech and discretionary also advanced, while communication lagged, and the financials continue to underperform the S&P 500. Looking ahead to Thursday, October 2nd, investors will be watching for key data releases, though the government shutdown may delay reports. Geopolitical tensions in the Middle East and escalations between Russia and Ukraine, combined with domestic uncertainties, have yet to significantly dent market confidence. Seasonally, October 2nd has historically been neutral to negative for the S&P and NASDAQ, but post-election year trends suggest positive momentum in early October. Technically, the S&P 500 has broken through resistance at 6,700, which could act as a floor if a pullback occurs. Short-term conviction continues to build, but intermediate-term indicators lack strong follow-through, and the S&P 500's distance from its 20 and 50-period moving averages does warrant caution. In conclusion, the S&P 500 remains firmly bullish, helped by expectations of policy easing and a resilient investor base. However, overextended indicators and mixed momentum suggest a cautious approach. Thank you very much, and I will talk to you in the next podcast.